The raise showed up in the payroll portal on a Tuesday morning and barely moved the annual total. By that point, the routines were already fixed. The commute was automatic. The calendar was full 3 weeks out. Health insurance premiums had adjusted the previous January. The mortgage payment had been the same for years. College tuition statements arrived on schedule. Retirement contributions flowed into index funds twice a month without discussion. The machinery of midlife income was operating as designed. At Kartesekin, the salary looked respectable on paper. The number would have sounded impressive 2 decades earlier. It placed him comfortably above the national median. The title carried the word senior. The benefits package included employer health coverage, a 401k match, short-term disability, and a modest life insurance policy. On tax forms, the gross income still signaled stability. But the annual increase, 3.1%, landed into an expense structure that had been expanding for 15 years. Property taxes had risen steadily as home values climbed across the county. Homeowners insurance had been recalculated twice after regional storm losses. The car insurance premium reflected 2 teenage drivers added to the policy. The grocery bill no longer resembled what it had been in his 30s. Even routine services, landscaping, utilities, basic repairs, had crept upward in small increments that never reversed. The compensation plateau did not announce itself dramatically. It appeared quietly, disguised as continuity. Performance reviews still occurred every spring. The language was professional and neutral. Consistent contributor, institutional knowledge, reliable leadership. There were no warnings. There was also no acceleration. The promotion tier above him had narrowed after a corporate restructuring. Executive roles were fewer. Lateral movement required relocation, which would have meant uprooting a household that was deeply anchored to schools, community, and aging parents within driving distance. The first realization came not from income but from comparison. New hires in their early 30s joined the department at salaries uncomfortably close to his own. They were recruited into a competitive labor market with signing bonuses and hybrid flexibility written directly into their contracts. Their career trajectories were still upward sloping. Stock grants were structured around retention windows he had long since passed. Meanwhile, his compensation had stabilized into predictability. Predictability once felt like success. In his late 20s, variable income and uncertain bonuses had made budgeting difficult. Stability was the milestone. A fixed salary meant the mortgage could be calculated confidently. It meant daycare could be covered without panic. It meant retirement contributions could be automated instead of aspirational. By the late 40s, stability had shifted from aspiration to boundary. The 401k balance looked solid at a glance. Years of consistent contributions and market growth had compounded into a number that suggested progress. But projected retirement modeling, run annually through the employer's benefits portal, showed a replacement ratio that required continued max contributions into his early 60s. Healthcare costs in retirement were estimated conservatively. Long-term care assumptions hovered in the background without resolution. There was no crisis. There was simply no margin for drift. Compensation no longer expanded meaningfully faster than fixed obligations. The house, purchased at 34, had been refinanced once during a period of lower interest rates. The term had been shortened, not extended. The intention was responsible, paid off before retirement. The payment was manageable but firm. Selling would mean entering a higher priced housing market. Staying meant committing to the existing structure until payoff. Mobility narrowed. At work, Younger colleagues pursued certifications and strategic transfers. They spoke openly about equity upside and geographic arbitrage. He listened without judgment. His own decisions were anchored in accumulated commitments. 529 plans, partially funded but not complete, a spouse's career tied to a regional employer, parents beginning to require more frequent medical appointments. Compensation plateau was not just about salary, it was about optionality. Bonuses had flattened. In earlier years, performance multipliers had created occasional windfalls large enough to accelerate principal payments or increase brokerage contributions. Now, bonus percentages were standardized across divisions. Company earnings were steady but unspectacular. Shareholder expectations emphasized cost control. Cost control translated into moderate merit increases. Inflation adjusted the baseline of everyday life. Health insurance deductibles edged upward annually. Co-pays shifted. Prescription coverage tiers were reclassified. None of these changes were catastrophic. Each one required slight recalibration. Over time, recalibration became a permanent state. He began to notice that conversations with peers in similar age brackets carried the same undertone. No one described dramatic setbacks. They described containment. The career ladder in large organizations often compresses near the top of middle management. Layers thin out. Titles broaden, while compensation bands tighten. A senior manager at 39 might reasonably expect advancement. At 49, advancement depends less on performance and more on vacancy. Vacancy is unpredictable. The internal labor market had aged with him. Leadership turnover slowed. Executives delayed retirement during strong market years because portfolio growth made continued employment comfortable rather than necessary. The generational handoff extended quietly. Meanwhile, his taxable income hovered within a narrow range that pushed marginal tax rates upward without delivering proportional after-tax expansion. Federal brackets adjusted annually for inflation, but deductions phased out gradually at higher earnings levels. The child tax credit diminished as income thresholds were crossed. State taxes layered on top. Gross income growth and net income growth separated slightly more each year. Lifestyle had not inflated irresponsibly. There were no luxury vehicles in the driveway. Vacations were domestic and scheduled around school calendars. The kitchen renovation had been modest and financed through savings rather than credit. Still, the baseline cost of maintaining a middle-class household in a metropolitan suburb had increased materially since 2008. In his 30s, time was the lever. More years meant more earning potential. More earning potential meant more opportunity to correct missteps. In his late 40s, time felt structured differently. Peak earning years were present, not ahead. Yet, peak earning did not mean peak growth. Compensation statements from a decade earlier showed sharper year-over-year jumps. Those increases had coincided with promotions, team expansions, and a growing company footprint. Now the organization was mature. Growth rates had normalized. Expansion meant incremental acquisitions rather than explosive hiring. He found an old spreadsheet one evening while reviewing archived tax returns. At 35, his salary had increased 12% in a single year, following a role change. At 42, the increase had been 6%. At 48, it was just above 3%. Inflation that year was higher. The realization did not produce panic. It produced recalibration of expectations. The trajectory had flattened. Retirement projections began to incorporate smaller assumed raises. The modeling software allowed for manual adjustment of expected income growth. Reducing the assumption by 1 percentage point extended the projected retirement date by nearly 2 years. Increasing annual contributions offset some of that extension, but only by compressing discretionary spending that was already modest. College expenses were no longer theoretical. The first tuition bill had arrived the previous fall. Scholarships covered part of it. Federal student loans filled another portion. The remainder came from the 529 account and monthly cash flow. The 529 balance declined faster than anticipated once real invoices replaced estimates. At the same time, eldercare conversations became more frequent. His father's mobility had changed. His mother's prescription regimen had expanded. Medicare covered the majority of routine costs, but supplemental policies and uncovered services required coordination. The household budget now included two adjacent generations. Work still required long hours during reporting cycles. The compensation plateau did not reduce workload. It simply reduced acceleration. Colleagues who left for startups occasionally announced higher base salaries or equity packages on professional networking sites. Some relocated to lower cost states while maintaining remote compensation. He considered similar moves in theory, but the practical layers, school districts, property transfer taxes, mortgage rates on new loans, formed friction. The mortgage interest rate on his current home was below prevailing market rates. Selling would mean financing at higher rates. The payment on a comparable property would increase substantially even if the principal remained similar. Staying was financially rational. Rational decisions accumulate into long-term structure. Annual open enrollment periods reinforce the sense of maintenance. Reviewing health plans, adjusting flexible spending accounts, recalculating dependent coverage, these were administrative rituals of stability. None altered the fundamental income trajectory. He noticed that younger managers negotiated more aggressively upon hiring. Compensation transparency laws in several states had revealed salary bands that were once opaque. New entrants understood the top of the band earlier in their careers. He had learned those ceilings only after reaching them. Now he was at one. The performance rating scale allowed for incremental distinctions, but the compensation grid translated most ratings into a narrow raise range. Exceptional performance moved the number modestly. Budget constraints capped the rest. There was still gratitude for employment. Layoffs in adjacent industries had been visible. Friends in technology and finance had experienced abrupt income loss during downturns. Stability carried value. Yet, stability and stagnation are adjacent states. His brokerage account, funded with occasional surplus cash, grew primarily through market appreciation rather than new contributions. There was less surplus to deploy. Home maintenance projects, roof replacement, HVAC servicing arrived on predictable cycles. Insurance deductibles were met during minor claims. The financial system of midlife operated like infrastructure. Roads needed resurfacing. Appliances aged. Children required orthodontics. None of these were surprises. They were scheduled. Compensation plateau became visible when scheduled expenses intersected with flat income growth. He recalculated the percentage of gross income devoted to fixed costs. Mortgage, property taxes, insurance, utilities, loan payments, tuition, minimum retirement contributions. The ratio had crept upward by several percentage points over 10 years despite disciplined spending. The discretionary category, restaurants, travel, non-essential purchases, absorbed adjustments first. There was no dramatic cutback, just fewer additions. In earlier years, career ambition carried an implicit assumption. that effort and loyalty would be rewarded with proportional financial expansion. By the late 40s, the relationship between effort and income had stabilized into maintenance. The company valued continuity. Continuity did not require large raises. Healthcare premiums rose again the following January. The employer absorbed part of the increase, but employee contributions adjusted upward. The net paycheck shifted slightly downward despite the prior year's raise. He reviewed the pay stub carefully, not in alarm, but in recognition. The plateau was not a failure of planning. Retirement accounts were funded above national averages. Consumer debt was minimal. Emergency savings covered 6 months of expenses. The financial foundation was intact. What had changed was the slope. Career narratives often emphasize ascent. Midlife frequently emphasizes preservation. Compensation plateau is the numerical expression of that transition. At 49, the resume was strong. The LinkedIn profile was polished. Recruiters occasionally reached out, but offered roles at similar compensation bands, sometimes with higher performance risk. Switching employers might reset the growth curve slightly, but not dramatically. The market rate for his experience cluster was established. Established is a stable word. He watched the annual Social Security earnings statement update online. Contributions had been consistent for over 25 years. The projected benefit at full retirement age provided a baseline, not abundance. It would supplement savings, not replace income. The distance between current earnings and retirement income estimates clarified the purpose of the remaining working years. Sustain contributions, protect assets, avoid disruption. There was no single conversation that marked the plateau. It emerged through repeated exposure to similar numbers. Salary, incremental increase. Bonus, standardized. Expenses, incremental increase. Taxes, incremental increase. Over time, incremental symmetry feels flat. He continued to mentor younger employees. He approved budgets. He attended strategy meetings. The work retained meaning. The compensation simply no longer accelerated with experience. The plateau did not erase earlier gains. It contextualized them. At 30, the question had been how quickly income could rise. At 48, the unspoken observation was how long it could hold. Holding is different from climbing. The mortgage amortization schedule showed steady progress toward payoff. The principal balance declined each month. Equity accumulated. That forward motion existed independently of salary growth. It was mechanical, dependable. So was the plateau. In conversations with his spouse late in the evening, the tone was practical. Tuition timelines were mapped. Retirement contribution percentages were reviewed. Healthcare costs for aging parents were estimated conservatively. No one expected dramatic increases in household income. Planning assumed continuity. Continuity requires acceptance of limits. The compensation plateau in the late 40s is rarely visible in headlines. It does not resemble crisis. It resembles maintenance. It arrives after the ambitious years, settles into spreadsheets, and remains. The payroll portal will update again next spring. The percentage may shift slightly. The title may stay the same. The fixed costs will remain. The retirement balance will adjust with the market. The tuition bills will continue for several years. Property taxes will be reassessed. Income will likely move, but not far. And the slope, once steep, will stay nearly level.